And it's not even just about aligning the market structure. You can also align the fair value gaps. Now, for example, if we have a fair value gap on the higher time frame, we can align that fair value gap with the lower time frame. So let's use this fair value gap right here on the 12-month time frame as an example. Now, this is a 12-month time frame fair value gap. Now, if I wanted to take a buy on this asset class, euro, and I'm looking at this 12-month fair value gap, I can decide and say, okay, if I see a daily break of structure, I'll look for a buy and I'll buy it. That's a good way to do it. Now, if you also want a much more precise entry that will have a higher risk and also a higher reward, what you do is you align this 12-month time frame fair value gap to the lower time frame fair value gap. An example is you can go straight down to the monthly and see if there's a fair value gap resting inside this same region. So let's go straight down to monthly time frame. Now, when we go to the monthly time frame, you can see that we have a fair value gap resting here and a fair value gap resting below here. So what that means is price coming down into here or here, we'll be looking for what time frame break of structure. And can you see that this one right here, when price came down into this position, into that 12-month fair value gap, it didn't even slow down. It's literally continued going to the downside until it came down here to mitigate this fair value gap right here on the monthly. Now you can see how we've aligned a 12-month time frame fair value gap and we went down to a monthly time frame fair value gap. Now, once we see a 4-hour break of structure down here, we can start looking for buy opportunities. Now, someone else can still be waiting for their daily break of structure, which is amazing. But before they see the daily break of structure, we are already in the market. We are already making money.